So first of all, we're going to discuss market research and the economic outlook. So Dave, over to you on the size of the bridging market.
Thanks, Michelle. So until recently, the bridging market has been pretty opaque, but thanks to the growing membership of the Bridging Development Lenders Association, we are now getting a really decent view of that mainstream market, and it can be estimated at between 9 and 10 billion pounds annually, including development. There is also additional lending that exists from angel investors and family offices and other high net worths that will never really see the wider market. But it's sort of comprised of around £5 billion of residential bridging, and around £3.5 billion of that is unregulated, with around 1.7 of regulated bridging, which we've had verified by the FCA. There's around £2 billion of development lending as well that we tend to exclude when we're thinking about bridging generally. But with commercial bridging is around 45% of unreg, around £3 billion a year, really, really strong market. And in terms of growth and where it's been, the latest data from Q3 shows us it's actually grown 8% year on year, with unregulated bridging showing really strong growth at 14% up on the last quarter, and regulated at 3% growth. But with exits still fairly uncertain a little bit at the moment in the development scene, it's no surprise to see that lending in the development sector fall back a little on the previous quarter.
Thank you, Dave. Just talking about kind of trends from what lenders are seeing. So from a lender's perspective, the bridging market, as we know, is driven by time-bound opportunities. Lenders are employing technology to drive down completion times by way of introducing automated valuations, enhancing the automated valuation policies, introducing title insurance to guard against title defects and reduce processing times. As some of the larger lenders, like Together, are employing their own in-house legal teams. So here at Together, we have what we call an internal funding criteria, which means that we can process cases where there is, say, no transfer of equity, any title changes or purchases. Interestingly, we are also seeing a few lenders that offer higher loan to values, albeit many of these are focused on the refurbishment space. Now, from a customer's lens, they're increasingly focused on value creation. So what I mean by that is maximizing returns by identifying below market value transactions, including both residential and commercial properties, and adding value through refurbishment and or change of use. So standard bridging continues to play a pivotal part in securing properties pending, say, a change of use or any planning permission that's required, in addition to those light refurbishment projects. Then you have in the wider market, wider refurbishment bridging and full development finance offering a solution for more complex or bigger redevelopment projects. What we have seen is a shift of customers buying with a bridge to then resell, to those buying on a bridge to undertake works before refinancing and holding onto the property for a longer term investment. Now, because bridging loans are interest only and short duration, lenders heavily rely on the borrower's ability to complete the chosen exit. So lenders assess the feasibility of the executed conditions which affect the resale or refinance of the bridge, borrower's experience and credit profile, and any time buffer that's left after the intended event. So say, for example, if somebody's intended to do some refurbishment, what time is therefore remaining to enable either the refinance or the resale of the property. Now, if there are any concerns with an exit, it's very likely the lenders will want to understand the customer's alternative exit strategy, and they may ask for evidence of the same. So say, for example, if an exit strategy was to sell the property after refurbishment, say at month 9, as an example, could the customer then refinance onto term finance for a period of time if that sale was not achieved? And how feasible is that given the customer's circumstances? So, Dave, I'm kind of interested to hear some regulated trends that we're seeing in the regulated bridging market. So, over to you on that, please.
Thanks, Michelle. So, reg bridging has seen a growth of 19% annually since 2021. Really, really strong performance. And the year to Q2 25, the market was worth 1.7 billion. I'm looking at that, expecting that to exceed that by the end of this calendar year, perhaps as high as 1.9 billion pounds. But we've got some really interesting data from the FCA, which is fascinating, and just shows how the product is really widely used all across the UK and on all demographics, and really not just a product focusing on larger loans and high net worth and larger properties in the southeast, which is something I think is a widely held belief. In fact, 53% of loans were all under £250,000 and another 27% under 500k. So it really is it's really widely employed product, and it's clearly a really big growth market for everybody, and it's dominated. There's a lot of Together, obviously very, very strong in this part. There's also a lot of the challenger banks also excel in this space. But just looking at the other end of the scale, there are around 25 loans each month of over £1 million, which are primarily focused in the south of England. But when we think regionally, the hotspots for reg bridging, the southwest and Midlands have demonstrated growth of 20% this year, real growth in activity there. But leading the way is Scotland with a growth of 31% on last year. So really quite exciting space up there. But not surprisingly, the northeast is really leading the way with a 42% growth on last year. So there's just a lot happening in that space up there. So I think really exciting product space, reg bridging.
Thank you, Dave. And certainly with those regions and those loan sizes, it definitely sits very nicely in what we call our bread and butter loan sizes here at Together. But Maeve will be sharing with you later on in this session some of the larger transactions and how we've been able to turn those around quickly. So on to the economic outlook. So Dave, back to you on what you see as the outlook for bridging.
Well, after months of sort of trepidation and caution in the investor market, the budget's sort of finally come and gone, I think, as a big relief to everyone. And I think it's sort of left us with a sense of sort of meh. Really, a large slice of luck allowed the Chancellor to appease a lot of people when she was sort of gifted an unexpected, less pessimistic forecast by the OBR, and it allowed her to kick some of the cans down the road and avoid making some hard decisions. What we were looking for as a lender specifically, there were a few kites flown ahead of the budget that we were really concerned about, which was the 8% increase in national insurance for landlords. Thankfully, that played out as a 2% rise in property income tax, which obviously unwelcome. We don't see that as a major factor impacting investment strategies. We were also really concerned about increases in commercial property stamp duty, which thankfully didn't happen. That remains 0% on transactions up to £150,000. And then it's just staggered from there, 2% on the next bracket and 5% above 250. But with 70% of transactions under that £250,000 threshold, we may well see continued a lot of activity in that space. And also just playing into that was the changes in business rate multipliers as well. That may drive more volume into lower value commercial properties. And then finally, I think the other thing we were looking at was this so-called mansion tax. But, at £2,500 to, I think it's £7,500 additional tax on an annual basis. We don't see that really making any considerable impact to that market. it might well be just signposting the thin end of a wedge, I think, there for policy targeting wealth, because optically it's quite popular with the voters. I think you've got some news on the interest rate scenario for December. That's hot off the press.
Yes, hot off the press, because up until yesterday, the markets were pricing a 90% chance of a December cut. However, as per an update from Oxford Economics, I think the split is currently looking between 5 to 4 splits on whether or not a reduction is going to take place, because there's not enough evidence to support it. But the feeling is still for a cut in 2026. So with the base rate currently at 4% and inflation having cooled to around 3.6%, the bank is under growing pressure to deliver relief to households and businesses. So given recent comments from the Monetary Policy Committee and markets pricing potential easing, it's quite plausible that we will see some further cuts, perhaps the next one trimming the rate to 3.75%. But barring any fresh inflation surge or economic shock, some analysts are going as low as 3% in 2026, which was predicted by Capital Economics, and 3.25% is noted by Oxford Economics. But 3.5% seems to be the consensus across the market, and the bank will need compelling evidence to cut below this. Now, often we get questions here together on how bridging pricing is calculated when there is movement in the Bank of England base rate. So, Dave, can you give an insight into how we calculate this and other lenders in the market calculate bridging pricing?
So currently bridging rates are around, from a floor of around 58 basis points per month through to around 1% is about the top end of the market, which is generally accompanied by a 2% fee and perhaps even an exit fee, but that's usually a development finance feature. But most bridging is variable. There's very little fixed rate bridging pricing. So as a result, most of the fundings, the cost of funds is linked to SONIA. So as SONIA moves up and down, so bridging pricing can be really quite dynamic. But what goes into how a bridging lender prices? So we have our cost of funds. So challenger banks typically fund via their customer deposits, usually 1-year bonds and instant access. They're often cheaper, but they will deliver less flexibility, and they like less risk, more vanilla lending. Whereas non-bank lenders, such as Together, well, we're essentially resellers from the wholesale markets and private investment. So we often, not always, but have a slightly higher rate, but we offer the value there is enough, the wider criteria, greater speed and certainty, that's the edge that non-bank lenders can provide over challengers. But what also goes into it? Cost of operation, so underwriting, sales, cost to acquire, processing, treasury, legal, collections, all the sort of standard functions that you would expect any business to consider. But we also price for risk. So we have to consider what happens when loans go bad. So this is called expected credit loss. And that also plays a part in pricing bridging. But we also consider also the risk profile of the loan, whether it's a higher loan to value or not, the type of asset that we're actually lending against, and whether or not there is a credit profile that we need to be concerned about with the borrower, which is less frequent than it is in term lending. It's really all about the exit, as Michelle talked about earlier. We'll also consider the loan length. Short-term lending is normally around 12 months long. There are products to 24 months, but lenders are really consider it as short-term products, so they're looking for exits within 12 months generally. And finally, we also have to keep an eye on competitive factors. What's our competitive strategy in the market? What are the market dynamics? What are other lenders doing? Who are our target customers and our propositions, and how we want to add value to customers? And also, in the background as a lender, you also consider non-utilisation fees. So that can also impact pricing. So that always sit in the background. We may have, a vehicle providing us with funds to lend out. And if we're not lending enough of that money is costing us money. So that can also impact pricing, and that can positively and negatively impact pricing as well. So there's lots of things going on in pricing bridging products.
Fabulous. Thank you for that, Dave. If anybody does have any questions for myself or Dave on that section, then please do raise that in the chat section at the top. So now I'm going to hand over to our lovely Andrew and Colin, who's going to talk through some pertinent topics on trends and opportunities.
Hi, thanks, Michelle. Good news on the interest rate. I think it probably makes Colin and myself feel a bit more positive today. I think in terms of 2025, there's one word that really defines the housing market, and that's, or the property market in general in the UK, and that's subdued. You had a number of sectors performing better than others, but you obviously had quite a few sectors performing really poorly. Without gloating too much, and apologies to Colin, obviously the northern housing market has been doing a lot better than the southern. We're predicting 2 to 3% house price increase over the year. When houses go to the market, they generally go under offer at around 27 days on average, whereas down south it's 39. Colin, just to take your view on the housing market, obviously, London and the southeast in October are looking at reduced house prices about 0.1 to 0.2%.
Yep.
And also a 36% across the board reduction in kind of asking prices for houses on the market. How are you reacting to that as a valuer?
Thank you, Andrew. So I'm very much involved with this personally at the moment as well, because I'm actually selling my property at the moment, and I am, we've in my interpretation, we priced it correctly. The market is very stagnant at the moment. I live on Southend-on-Sea, if you can't tell by the accent, and it's supposed to be quite a buoyant, commuter-led town, of which there's a number of in that kind of perimeter of London. But it's just a real struggle at the moment to get anything moving. And I think what we're seeing, which is slowly infiltrating down to the values, is that no one's proceedable in the market at the moment. So I don't think it's an issue of getting funding. I think the money's there. I think it stems back from a lot of valuers perhaps having a very cautionary stance to protect themselves, as they should in the current economic climate. But what that does mean is subsequently what someone's prepared to offer for a property doesn't necessarily mean that's what it's worth. I know that goes against general logic. But unfortunately, what it's doing now is the market's clogging up. And where we're seeing movement is probably on the first time buyer side of things, so probably sub 300 grand. That part of the market's moving okay. And obviously the top end of the market, it's a market unto its own. But those people in between, those second, third, fourth home kind of movers, they're the ones that are kind of stuck in the middle at the moment. And the stats are right. I think the prices are dropping, and I think we're still catching up from COVID, when all the agents were hell-bent on trying to win instructions, and were kind of over-quoting the value to win the instruction. And I still think we're feeling that today, unfortunately.
Yeah, and I agree. I think obviously the budget hasn't helped, all the kind of caution up into that, and, the potential tax on houses over 500,000. And I saw an article the other day, I think, which said around 210,000 homes have effectively been saved from an annual tax. So hopefully that might bring more activity in as people have got more certainty. None of us want to pay more money a year. So, buying a house on higher values is obviously affecting it. So, Colin, in terms of the budget, how do you see the new policies affecting the housing market next year?
I'll try to keep my political opinions to myself on this one, but I think the uncertainty that we had up, in preceding kind of 2 months had a real knock-on effect on the market, and buyers' confidence as it stands, and also this time of year as well is historically pretty quiet. I think in terms of I think David made a good point. A lot of the actual tax side of things, from a monetary point of view, it's optics. It's political jostling. I don't really think it's going to make too much of an impact. for the people that can afford those mansions, so to speak. It's it's not a huge amount of money. And to put it into context, to be buying as you guys will know, to be buying a £2 million, well, it might be a mansion up north, or it might be a townhouse in London. Your household income is going to be over £500,000 so you're not really going to feel it too much. I'm hoping now that because the budget wasn't as bad as I think a lot of people thought, I like to think that we are slowly now going to start to see a bit more confidence, and it's going to be hard to differentiate that between seasonal trends, because obviously historically at Christmas time everyone sits online, they're on Rightmove, they're looking at potentially how, babe, we had a couple of wines, should we move? It's kind of what happened when I done it. So I'm quietly confident, but I think confidence for me is not necessarily price rises, it's just getting that market moving, and I think that's the big thing we're seeing. And without me rambling on too much, my biggest bugbear as a valuer is when we're sent, we think it's worth X, and they've based it on what they've seen on the market, not what's actually sold. And I know, Andrew, we've had these chats multiple times when it comes on the QC side of things. And I think that's really important for anyone listening, is when they're speaking to their clients, is, it's all well and good putting a deal through based on what you think it's worth, but actually have some substantial evidence behind it to justify it. Otherwise, you're just going to get a down val. And that's not going to, a realistic val, I shouldn't say down val. And that's just not going to, it's just not good for anyone involved.
No, I agree. And I think, hopefully, as we said earlier, with the interest rate moving down to 3.5%,
yep,
we're all hopeful of that. Nobody can tell where inflation's going to go. So we've got to keep positive. I think one thing in 2025 that, has been a real good thing for instructions is obviously been the HMO side of things. We've seen a vast increase in that, be it either for current HMOs or for conversion to it. What's your thoughts on the reason behind that, Colin?
So HMOs, I mean, we do a hell of a lot of HMOs for you guys, and they've almost become part and parcel of our business plan, in terms of kind of becoming at the forefront of HMO valuation work, because I think there's two main drivers for it. I think obviously the obvious one is that it's expensive to buy property now, and a lot of people, are renting, and HMO seems to be the obvious thing for people to do that can't afford to actually rent properties. I have my own ethical views on HMOs. I don't love them personally. I've seen some in my time where there's 3 or 4 people in a room. I don't love that. I don't think they're policed very well. But I also think people are very much aware that there's a lot of money to be made. My big concern with HMOs is obviously on the exit. It's very rare that you'll see a HMO sell for anything near what it's been refinanced at. But is that more of a perception that it shouldn't necessarily be valued as a physical asset and more of a business? Because it is a business, fundamentally, is what it is. But obviously the trend, if you just go on social media and your algorithms linked to property, you're going to see HMO investors telling you how easy it is to get rich and, and all that jazz. And I think it's quite a trendy place for people to invest. And, hopefully you're in the right area where you can get those decent yields. And then, you pull your money out. It's a great financial scheme. I mean, we've looked at it as me and my, pals are back home, but, I'm kind of sticking to short leases for now, but yeah, it's an interesting time, and I watched HMOs with a bit of nervousness because there's a lot of them going out, but I still think that amount of income coming in. But I just think people aren't aware of the obsolescence risks that come with a HMO. A lot of people are spending a lot of money straight off the bat, making it very nice and sexy and all that jazz. But what HMOs are like, in and out, the amount of people coming in and out, there's a lot of kind of damage, and just they deteriorate a lot quicker than the standard properties. And I think a lot of people forget that in their business plans, they don't necessarily factor in that probably every 7 or 8 years, they're going to have to kind of redo the whole thing again. Yeah. So it's not necessarily the cash cow that people think it is. But not to say I don't like HMOs, because it made me sound really negative then. But yeah.
Yeah, I mean, I think they're becoming prevalent on the basis that if you look at the return from them and you look at the rental growth over 6 years from 2019, it's estimated at 35%. So if you look at any other sort of property market, where have you had such a big rise in rents? And all the investors are seeing that. But I think there is a tipping point where there's only so much you can put in to get back. So you're right in that regard, Colin, I think. What's your thoughts, Colin, on the kind of movement in terms of rooms and HMOs to more a studio akin room? So you're seeing now amenities being put in by landlords where they have a kitchenette in and an ensuite.
Yep.
Why do you think that's been driven?
From a valuation point of view, the kind of material change of the building does have quite a big impact, especially on the yield side of things, because very logically thinking, we're back in Southend. I hate to keep referencing where I live because it's not great, but back in Southend, it's a big HMO hub. And there's a lot of very beautiful old kind of Victorian townhouses that are getting converted into HMOs. And some of them are having very little material change. They're not even really bothering to put en suites in some of them. And it's very much shared communal access. And, it's not necessarily something that I would love to go to myself. But they're in theory, what they're getting valued up at on the investment method compared to the bricks and mortar of a property next door. Sometimes in some cases, it's nearly double. So it's obviously, lenders are obviously very much aware of that. And obviously valuers are kind of pulling back now on these yields. And I think that's why the trend to kind of make these almost self-contained little flats is becoming greater and greater, because ultimately you're creating more value that way. And I think long-term is going to be a bit more of a secure asset. And fundamentally, the better quality accommodation you've got, the better rents you're going to command, which is going to be a better investment long-term. If you've got everyone kind of coming into the community areas left, right and centre, then like I said earlier, that risk of obsolescence is a lot greater.
Yeah, no, that's good. I agree with you. In terms of, obviously, there's major concerns coming forward in the sector. The Renters Reform Act has obviously now got a date where it's been implemented of May next year. And that essentially is where the existing tenancy assured short hold fixed terms will be changed to a periodic tenancy. Do you think that'll have an immediate impact on the market?
You're probably seeing it as much as I am on the kind of buy to let stuff. It's for me, I grew up in the renting accommodation myself when I grew up, so it's a matter quite close to my heart. And I actually called into LBC about this when I'm one of those sad people, first time caller, long time listener. But it's fundamentally the issue I have with the Renters Reform Bill is that by making it more difficult to evict tenants, it means the actual initial screening criteria has become a lot more stringent. Yeah. And fundamentally, if it's your asset, then you're going to be looking for someone that has a flawless credit rating, or as best as you can get, doesn't have any kind of CCJs, doesn't have anything like that. But that doesn't always tell the story of the applicant, and who you're getting in. And there might be someone that fell into kind of a bit of a bad credit patch because a partner left them or whatever, and they're the ones that are going to be left aside. And it's without sounding too evangelical about it, it's I think they're the people that are going to really suffer on this. In terms of the buy-to-let market, a lot of our buy-to-let clients that we know are kind of coming out of the market because there's not the same returns there. You're also now, if you're not running it for an SPV, you're getting taxed heavily on your mortgage payments and stuff. So it's just not a great place to be in the buy-to-let market. The ones that we've got as a firm that we own in our portfolio, we barely make any money from it at all. We kind of just have it for capital appreciation. And I generally think that is why a lot of buy-to-let investors do these days, is to have the asset and just hope in the long term it's going to be there as a little pension pot.
Yeah, I think it's smaller landlords that will really feel it, because if you look at it, you've just essentially been hit by an NI increase with a budget. You've then got, in essence, a real risk that a tenant can just one day go, here's my notice, I'm off in a month or so, and there's nothing you can do. So in terms of the whole investment side of it, if you can't stomach that type of risk, you're not going to be wanting to be in the sector anymore. And I think you're right, Colin, it's less attractive. In terms of the Section 21 evictions, Colin, obviously that's been pushed back. It's not going to come in immediately. Do you think that adds a bit of positivity? Or
yeah, that does add a little bit. Like touching on your point, it's ultimately rents will go. If something's more risky, the rents go up.
Yeah.
For someone to want to go in and who's losing, it goes against the whole point of what they were trying to do, which was to help renters. But yeah, the delay is definitely going to add a little bit of security for our buy-to-let investors. But ultimately, they know it's coming at some point, or under this Labour government, it's going to be coming. So yeah, unfortunately, it's I don't have huge optimism at the moment on the buy-to-let front. I'd love to be able to sit here and say that I do, but I just urge people just to kind of tread quite carefully when they're kind of looking at kind of buy-to-let deals.
Yeah, I mean, obviously the renters reform, one thing, I'm similar to you, Colin, I have properties as well, and everything's starting to mount up. But I think one reprieve we have is Arab's law and the decent home standard. It's obviously being pushed back to 2035 to 2037. So that gives people a little bit of reprieve in the fact they're not going to have to go and spend a lot of money putting houses into a good standard. What's your view on that, and how will you react to it as a valuer? Is it going to be positive or?
Yeah, I mean, I think it's a lot been waiting to happen for a while. It's just a tragic shame how it kind of came about. But it's amazing. Like obviously, I know you guys will just see numbers on the screen sometimes, but obviously, as us valuers on the ground, we go and see a lot of these places. It's amazing the difference in quality that some landlords provide for their tenants. And some of it is absolutely abhorrent. And it goes without saying if the property is not in a good state, it's ultimately going to affect the value. But it's a no-brainer. So it just hopefully is that kick up the backside that the sector really needed to kind of just improve it a little bit, because fundamentally these are people's homes, and with improvement the rents get better. More people start investing, and fundamentally it's better for everyone. So I was glad to see it come in.
Yeah, I think it'll be interesting as well. I mean, I had one of our lender clients, the first one, has asked me to actually build into a template a renters reform section, and one part of it is what repairs and maintenance do you envisage over the next 5 to 10 years to get at the stand of decent homes? I think that's a good way to go.
That'd be really good, mate. Really good, mate.
It allows them then to build in the affordability factors on top of their risk papers. So I think that'll be a help. In terms of the commercial market, Colin, obviously it's been subdued for years. You do have certain sectors, logistics, industrial sectors, really performing well because we lack good quality industrial properties. But there is a point where we're 26% below where we should be on a quarterly average. How are you reflecting that in your valuations?
Interesting. I mean, commercial, just on a granular level, our end, we've seen a real kind of upturn in kind of instruction level on the commercial side of things, and there is a massive need for good industrial stuff. I mean, especially on the light industrial, where my office is, we're on a light industrial park. And I think the demand is there, but obviously where there's not enough and there's a shortage, then fundamentally yields come up because there's not enough supply. So I think commercial values have creeped up over the last 12 to 18 months, and a lot of our guys that have left the buy-to-let market are coming into the commercial space now. So I think it's where we'll be looking at our investment strategy over the next 24, 36 months, and I think a lot of it's going to be very much focused on mixed use and just kind of light industrial units where we can get hold of them. So we're confident on that stuff.
Yeah, I think that in offices as well, because we're now finally start to see a change in the trend of people working from home. Savills have recently done a report which is quite interesting to read, where they're saying that I think it's about 46%, and people actually want more space rather than less because they're trying to attract younger people back to the office as well. So I think we've got sectors that'll do well. I do think secondary retail, for anybody listening, is going to struggle still. There's so much oversupply of it in these town centres that rents are just going to continue to go down. But I think we're in for interesting times in 2026, Michelle.
Agreed, mate. Agreed, though. But if anyone's, I didn't mean to sound really negative on that. There is a lot of optimism in there, but as a valuer, it's kind of been drummed out of me over the last 24 months. So, it's there is a lot of reasons to be optimistic.
Definitely. And certainly when you both were talking about, Colin, you mentioned about some of the not so positive states of rental properties that you've seen as a valuer, this is a perfect position to utilize bridging finance, right, to update those properties for those to be suitable for tenants to move into. And this is where lenders like Together can offer, say, second charge residential bridging to offer the funds to undertake those works before then renting the properties out. So thank you both for that. Some fantastic insights there. So now I'm going to move over to Stephen to share with us how Method can support our brokers.
Thanks, Michelle, and good afternoon, everybody. We're delighted to join Together and all of you on the webinar today. Method has been working with Together for a number of years now, and we've grown significantly during this time. Over the last couple of years, our volumes have increased fourfold. Our partnership with Together and our growing reputation with the broker space has been a key driver of this, so we're delighted with all of that. I'm sure many of you will know of Method already, but if not, Method provides Together with valuation panel management services, meaning that we connect Together and you, their broker contacts, to a panel of around 200 valuation firms. This panel provides full cover across the UK, including Northern Ireland, Scotland and Wales, but we've heard some of those areas mentioned today already, and across the full range of property types, from standard residential through buy-to-lets and HMOs to every type of commercial you could imagine. So really do offer that full panel coverage. So how can Method support you with your Together loan applications where you need to source a valuation to provide that fully packaged application? Well, Method offers a panel management service that's the perfect combination of people and technology. We really do take the hassle from procuring valuation reports. This means that the service we provide is something that we're really, really proud of. To put that into context, 91% of the valuation quotes that we provide and receive from our panel, including Colin and many others, arrive to Method within 4 hours. So 91% within 4 hours, which we think is excellent. More importantly than the quotes, of course, is the receipt of the valuation reports. And 93% of the valuation reports returned by our panel are received within the timescale set out by Together. So 93% received it in time. I'm sure you'll agree that these are really good, very important for bridging, given the time sensitive nature of it, and hopefully they help you and Together deliver lending to your borrowers. Another reason that the service that we provide is a little different and very important is we put you, the broker, and Together in control of that valuation journey. Our direct messaging functionality connects you directly to the valuers, and our operations team are there to help iron out any case wrinkles quickly to help you get valuation reports in good time and get those tight timescales met. Not only do we provide a great service, we give you confidence that any valuer proposed by Method is acceptable to Together. And all of this sounds expensive, doesn't it? But it shouldn't be. And through Method, we're proud to say that it isn't. We provide our services at a justifiable price point. So Method's fees are fixed, relatively low cost. Method's fees are not linked to the size of the valuer's fee, nor the estimated property value. We believe that's fair to you and your borrowers. So to wrap up, we're continuing to grow, driven by the great service that we're providing to brokers and lenders. And if you're not already working with us, then please drop us a line, either to Andrew or I personally, or to the team inbox mentioned on the slide on the screen there. And we'll be delighted then to get you set up on our system. So we look forward to further supporting Together and more of you, their brokers, over the coming months and years. Thank you for your time. Michelle, back to you.
Lovely. Thank you, Stephen. And yes, I concur that certainly speed of service, not just at Together, but our wonderful partners in Method, is really key when processing a bridging transaction. So on the topic of speed and service, I'm going to hand over to our fabulous Maeve Ward, who's going to bring with you, so I say, a couple of our recent cases that we've completed at speed, because reiterating, bridging at speed is fundamentally important. So Maeve, over to you.
Thank you, Michelle. So yes, I've got two case studies to showcase for you that we've done very recently. One obviously over the unregulated market and the other obviously a regulated bridge. If we start firstly with the unregulated bridging transaction that we did, for me personally, when I sort of pulled this one together and stepped back through it, I thought it was a great example of where Together uses sort of humans for expertise and judgment in their lending decisions, but then the way in which we work with our system and our processes, which helps us transact at speed, which ultimately prevents opportunities being lost, obviously, for property professionals, property investors, helping them realise their property ambitions. So what was the scenario in this particular one? They were experienced property professionals, but it was a complex nature in the sense that they were buying a residential property, which they were going to add to their portfolio, but they were purchasing it in a limited company name, which they were then going to rent back to one of the directors within that limited company. They had a lender lined up, they were quite far progressed, but at the 11th hour, and it does happen, that lender for some reason didn't want to lend. They changed their appetite, as an example, and unfortunately that does happen. But they needed a lender to step in very, very quickly, but a lender that could actually transact at speed, could offer the flexibility that they were needing, but more importantly now, because the purchase was obviously at risk, was certainty of funding. So who better to do that than Together? Together's been opening their doors for over 50 years. And so they approached Together, they explained the scenario, we were comfortable with the complexity, we liked the experience of the borrower, we could see the portfolio and the assets within that, and we were able to actually turn that transaction around in 2 working days. So you're probably thinking, how did Together do that? Well, it was our flexibility, it was our sort of common sense to lending, but also the experience of our underwriters. We were able to take a view on the valuation that had already been done, and we were happy to accept a retype 2 Together. But also I mentioned it was quite far progressed in terms of the legal work. So we were happy to obviously do this as dual representation. So when you put those 2 things together, we were able to transact that in 2 days. But there was also 3 exits, and Michelle touched on this right at the very beginning, the importance of the exits and having a contingency. On this particular deal, there was 3 potential refinance options, one of which was ourselves, because we do bridging and we also do term, which was great. But also I mentioned the portfolio. So there was a further contingency within the portfolio should it be needed. If anything went wrong with those refinances, we had some other options there. Okay, so that was the first transaction. The second transaction is obviously of a regulated nature, and I'm sure many of us on the call have gone through this and experienced perhaps being in a chain when you're purchasing a property. Now, this is more personal because there is emotion behind this one. This is going to be your main residential property, or perhaps a holiday home or a second home that you have. So there is lots of emotion attached to that. From some research that Together did themselves and their insights, there was like 49,000 chains in 2024. So lots of people sort of caught up in a chain. And we all know that it's one of the most stressful things that you will do. And if property transactions are linked, if one of those fails, as an example, so a buyer pulls out or it takes too long to get the mortgage in place, which again, some market insights from Together's research actually stipulated that the average sort of time to get that mortgage in place now is around 109 days. So a significant amount of time, that it is quite stressful and it does cause anxiety. And actually the market research mentioned that some of the customers that they spoke to actually noted that they actually felt more control in the deposit. And actually understand that, because the deposit you can control. Yes, it might take you a long time to get there, but you're in control with how fast and how big that deposit comes. But when you're actually purchasing a property, you're not in control. Anything can go wrong, but you've already bought that property in your head. You've already bought it, you've already designed the kitchen, whatever it is that you want to do. And so if it does start to look like it's falling apart, then obviously that can cause significant stress, which is what happened in this scenario. So they wanted to get themselves out of the chain because they wanted to go ahead with that purchase. They didn't want to lose that property. They reached out to their broker, who was informed about bridging finance, which was fantastic, and had strong relationships with regulated bridging lenders. It's worth noting that the regulated bridging space hasn't got as many lenders in as the unregulated bridging space, so there are fewer options, but they came together, again, very similar to the other scenario. They were looking for certainty of funding, they were looking for speed, they needed this purchase to go through. We were able to transact that for them on a cross-charge basis. So we took a charge over the property that they were purchasing, also a charge over their main residence, which was up for sale and being sold. And we were able to turn that around in a matter of days. How we were able to do that, very similar. We used automated valuations as opposed to full valuations, and we had dual representation. Both of those two things save time, but also money, because the dual rep process is absolutely free. So there was no cost to the borrower, who had already incurred significant cost. The sale was obviously sale of their existing main residence, but it just took the pressure off. That property could be sold to pay us back, but they were able to go on and secure their new dream home. So if I then just finish both of those scenarios up, just talking more generally around bridging, from everybody today, you've heard about the growth of the bridging market. It is growing. More awareness around sort of short-term solutions, especially with the growth of specialist lending as well, is key. So brokers jumping on webinars like today to either enhance their knowledge or learn about it for the first time is absolutely fantastic, because it can be the difference between opportunities being lost and dreams being shattered. Having that information at your disposal, that you can actually have conversations with property investors and with clients right at the get-go to talk about, if it goes wrong, there are alternative lending solutions out there. That just gives people peace of mind that hopefully nothing will, but if it does, there is an alternative. But also, if you need to transact at pace, it can actually be the right outcome from the get-go to use the bridging finance. Having relationships with your lenders, with your BDMs, but also, time is money. So if this is something that is relatively new to you and you want to learn more, that's fantastic. But if it's to have control of the conversation to ensure that your customers are best protected, that's great. But you can also refer to other people that predominantly bridging finance is their specialism. So it's always worth being best informed and then partnering with somebody else if you want to, if you don't want to own that direct. Because ultimately you want to protect your client bank. You want to have all the options in your toolkit, whatever the scenario, for whatever conversation, when your clients come to see you, that you can discuss what is the right outcome for them. And whether you own that directly or refer is entirely up to you. But what it means is that your customers stay with you and that you protect your client bank.